Hi everyone, I want to welcome you to this information video on the Options for Profits course and signals. I'm going to be going over a lot of information today on the signals as well as the information that you'll learn in the course. I'll be answering a lot of questions that people have with regard to this program. But I want to start off by talking a little bit about the foundation. Since the inception of the Options for Profit signals, they've produced an actual trade track record of 249 trades, 234 winners, and only 15 losers. That's a 96.4% winning track record with actual trades. It has produced winning streaks of 52 trades, 41 trades, 38 trades, which is the current winning streak, 32 trades, 24 trades, and 15 trades. And there are many success stories with the Options for Profits, including one client who turned a $50,000 account into almost $450,000 trading the OFP signals during a 3-year span. Now, the reason I'm telling you this is because you need to understand why I'm about to make the next statement. Whatever you've learned about options, throw it away. And that's not to say that everything that you have learned about options is wrong. But it is to say that you need to understand options from a different foundation than probably what you have traded from in the past. So for example, would it surprise you to know that in the process of picking the trades for the OFP signals, never once did I ever look, refer to, or consider any of the Greeks? I never once used the delta, theta, gamma, or any of the other Greeks in any of the decisions at any point. Not before the trade, not during the trade, not after the trade. That will probably come as a surprise to many option experts. But that's not all. In the course, you'll also learn why the absolute worst exit strategy an option seller can use are stop losses. And I know that statement shocks probably just about everybody listening to this lesson, but I'm speaking from a mathematical standpoint and a probability standpoint. The worst thing you can do as an option seller is use a stop loss as your main exit strategy. Another key foundational point is that if you want to succeed in option trading, and for that matter, if you want to succeed in any trading, you need to first focus on the risk. And that's what we do in the Options for Profits, both the strategy, the course, and the signals. And I'll cover that a little bit more in this video as well. Finally, it might surprise you that these winning streaks, including the 38 trade winning streak, came from a signal service that only comes out twice a week after the markets close. At no time do you ever need to watch the markets. You place your order in before the market opens, let it sit, and that's it. There's no market watching. This is the foundation from which the current 38 trade winning streak came from, and all other winning streaks experienced by the option signal service. Unorthodox, contrarian, counterintuitive, all of these are terms that have been used to describe the OFP approach and signals. And that makes sense when you think about the fact that 90 to 95% of all traders lose, and that includes option traders. This is why I require all signal subscribers to take the Options for Profits course. It's an online 12-hour course, and it will change how you look at options. If you want to follow the signals, though, you need to understand why we do what we do. If you don't, you'll second-guess the signals, you will apply your own untested logic to certain trades, and you'll run at the first sight of blood or a losing trade. And none of those are good. The Options for Profits course and what you learn and the signals are unlike all the other option courses or any other signal service that is out there. Most of them repeat the same old mantra: Greeks, stop losses, etc. But when you go through this course, you will see the folly in some of the most popular option approaches out there, and then you'll see the proof in the track record. Now again, I am not saying that none of the other courses or strategies out there are not profitable. I'm sure some of them are. But if you really want to understand the practical aspects of how options work in the real world with real trades, this is the place. In the OFP course, I completely reveal the logic, the principles behind both the entry and the exit strategies used in the OFP signals, and then the signals, you see them happening live. Now the OFP focuses, the course and the signals, both of them focus on futures options. The principles and the strategies you will learn can be applied to any option market, including stock options and ETF options. But the best opportunities for this approach are generally found in the futures options. And I'll show you why here in a little bit. So take, for example, the first 11 trades of the current 38 trade winning streak. You have here a market in KC, that's coffee, a trade in FC, that's feeder cattle, CL, which is crude oil, S, soybeans, HG is copper, ZB is bonds, and then you start to see that repeat. You'll also notice that these trades are not very long in length as a general rule. So here we have a 7/13 is the entry date and 7/23 is the exit date. That's 10 days. 7/16 versus 7/27, 11 days. 7/19 versus 7/23, 4 days. So you can see that these are not long-term trades either, but the profit is still pretty significant in most of these. So why futures options? Mainly because you're dealing with leverage. And when you're dealing with leverage, it means that you can go way out of the money. So here's an example. In the blue is the option price. The option price is on the left of this chart. The black is the actual underlying price of crude oil, and that is based on the right side of the chart. This is an actual trade that we took in the track record, and the red arrows point to the day that this particular trade was hit. We sold a crude oil 105 call for $600 while the market was trading around 95. We sold with approximately 33 days left until expiration, and at the time the strike price was over 10% away from where the current price is. So the current price was trading below 95 and the strike price was at 105. Now you'll notice that the market stagnated and moved higher, a little bit higher, but at the same time the option price tanked in this particular set of circumstances. And this is a winning combination. When you have a strike price that is far out of the money, when you have an expiration date that is between 30 and 50 days on average, and the market doesn't go anywhere, you see the option prices tank, and you usually see them tank fairly quickly. And that's what happened. We entered on 8/16 and we exited on 8/30, and when we exited, crude oil was trading higher than where it was when we entered just 2 weeks before. And we exited that particular trade for a $450 profit. Here's an example of an update that you'll receive twice a week. The option house signals also, that's the particular strategy within the Options for Profits course. This is for 114.13. Here are the new signals, very straightforward. Sell March crude oil, gives the symbol 103 strike call for 60 or better, and I put the dollar amount in here just so that there's no confusion, $600 or better. And this is always a limit order, so we sell it at 0.6 or higher on a limit. Here's one for the bonds, here's one for coffee, here's one for natural gas. I put the action always, whether we enter or exit a position, and then we keep track of the open positions, and we have exact exit signals with the open positions. Now if there are special notes or commentary that is needed for one of the positions or more, or in general, then that's found in the notes section. And this is what is received twice a week. Now I get this question a lot: if stop losses are not used, how are risks managed? Well, I want to explain this just a little bit before we get into the 5 basic strategies for managing risk. First of all, an out-of-the-money option means that the entire value of the option is time value. We sell only out-of-the-money options, and usually they're pretty far out of the money options. And as long as they remain out of the money, that means that the entire value on expiration day is going to be gone. So there's no actual loss until the option goes in the money. And when that happens, the time value is replaced with intrinsic value. So for example, in the crude oil call that I gave earlier, the 105 call, we sold for 0.60. The break even then was 105.60, meaning that if on expiration day crude oil closed at 105.60, we would break even on that particular option. A 1-to-1 loss would occur if on expiration day crude oil closed at 106.20, meaning we would lose $600. Our profit potential was $600. That's our max profit potential. A 1-to-1 loss ratio would occur at 106.20 on expiration day. So when an option goes into the money, time value is replaced by intrinsic value or actual value. And as a result, we usually do not exit a losing position until it goes in the money. And how soon we exit after it goes in the money depends on how much time is left on the option. So if there's a lot of time left, we usually exit sooner. We're quicker to exit if there's a lot of time. If there's not very much time left, then we may implement a different type of strategy. So here are the different types of risk management strategies that you may see. You'll learn in the course, you'll learn about all of them in the course, but you may see them in the signals from time to time when we actually see a potential loss. So the first one is that we'll replace the position with a further expiration and further strike price option. So for example, if our March crude oil goes into the money, we may exit that one and replace it with an April crude oil further striker so that it's still out of the money for the same price that we exited the current one. You'd be surprised at how often you can do that in order to extend the length and the amount that the market has to go in order to extend the trade. So that is one of our potential risk management strategies. Second one is to simply exit when the option goes into the money. And when that is best used is explained in the course and of course in the signals. Another one is to create a credit spread. And we create the credit spread not at the beginning of the option, but only when we want to potentially limit the risk of a current option that has the potential of dealing us a loss. And there are specific circumstances that you do and you do not want to use each of these, including creating a credit spread. So these are very circumstantial type risk management strategies. There is one that is better for every circumstance than the other. And that's what you'll be learning in the course. 4, cost average. If we're short 1, we may very well go short 2. And cost average, depending on the price at which, if the option is hugely inflated, we may opt to a cost average. And then the 5th one is to buy or sell the underlying to cover the potential loss. And this one is used sparingly and with much caution. And that is also explained in the course. So the OFP course discusses all of these. And when it comes time to manage the risk in an actual trade, they're explained in the update with exact instructions on what to do and why. So there is no guesswork with the signals, and you will learn as we go through a potential loss the thought process. Now granted, we don't go through it very often since we win 96% of the time, but there are some trades where we win and we still are looking at potentially managing the trade as a potential loss. And by the way that we manage it, it ends up being a profit. However, the biggest risk management strategy is not what we do after we make the trade. It's what we do before we make the trade. Real risk management starts in being patient and waiting for the right opportunities so that the probability of realizing a loss is very small to begin with. That really is one of the biggest secrets in this whole program, is knowing when to wait. And we do a lot of waiting. We're only in 3 to 5 trades a month. And it's because we're waiting for the highest probability opportunities. Now with this program, there are no refunds. And I do get some people that complain about that, but you have to understand that the subscriber base to the signals is very, very limited. Volume in the futures options is not tremendous. It's not millions of options, option contracts. So when we place a signal for a specific strike price, we want to make sure that we're going to get filled, and we want to make sure that our clients are going to get filled. So we have to limit the number of traders who are committed, a number of traders who are involved in the subscription. So we only want traders who are committed to the program. I don't want to be dealing with people who are waffling in. They're not for sure about what they're getting involved with. They're not for sure whether they really want to commit to learn this or to do it or to follow it or whatever the case is. So we want to make sure that those who get involved are committed. Secondly, all of the logic is fully revealed in the course. The course information and the process of picking the trades and managing the risks comes from years of extensive research and experience, and in the long run, the strategy really is worth 100 times what you're paying. I simply am not going to give this away for free. Thirdly, the probabilities are fixed in your favor. A loss or even several losses do not negate the future probability of success with this strategy. That is just part of the risks, and you have to know that going in. There's a 92 to 94% probability of success with each individual trade, and that's based on if you hold until expiration. And as you saw from our track record, we don't hold until expiration if at all possible. We get out at a certain point when the probability of holding on is not worth the risk of holding on. So we get out. Average trade length is 11 days, which increases the probability of success because we're not holding on to it and allowing a winner to turn into a loser as a general rule. And because of this, the probability is that the entire course and the signals will have paid for itself within the first 2 or 3 trades. That's not an absolute guarantee, but that's the probability. So it's a very valuable program that you're getting involved in here. So what does it take to take all of the trades? If you want to take every single one of them, and you don't have to, but if you want to take every single one of them, I suggest a minimum of $20,000 in your account. However, you can start with a smaller amount and pick and choose the trades. Look, since each of the individual trade carries a 92 to 94% probability of success, you can place on just one trade at a time with less than $10,000 in the account, and you should be just fine. Now, since the average trade length is 11 days, there are months where you will be able to take more than one trade in a month with a smaller account and still never hold more than 2 open positions at any given time. And with a $10,000 account, you should be able to hold 2 open positions at any given time in most cases. But if you didn't want to do any more than just 1 open position at any given time, you are looking at the potential of possibly 2 trades a month. And each trade gives you a potential of 3 to 4% for that month. So if you are able to average 2 trades every other month, you're looking at a return of 5 to 6% on a monthly basis. And most investors are happy doing this in a year. If you start off with a $20,000 account and you take all trades, we've been averaging between 7.5% and 10% per month. Now, as of this video, the recording of this video, there are 17 spots left. And in all likelihood, they will be gone by January the 25th, which is at the end of the week. Now, we do have about an average of 5 spots that open up each month. The traders either didn't follow and didn't take any of the trades. We do have that from time to time, and they don't renew, or some traders who become comfortable enough to take the trades on their own. Regardless, about 5 spots open up each month, But when the next group of spots open up after we fill this, the 17 spots that are left, from this point on, any spots that open up will be at $9.97 a year due to the supply and demand. But as long as you remain a subscriber, the price remains at $7.97 a year. You grandfather yourself into that price. Eventually, we will increase the signal service to $9.97 for 6 months. So this is a very good opportunity for you to get involved in something that's different than anything else that's out there. It's something that provides a real-time track record that spans back going years, and something that's very limited. Not very many traders have the will have the opportunity to get involved in this. So take a look at the here's the link where you can find more information as well as get on board. Thanks for attending this video.